Well, thank you, Paige, for that introduction. Hello and welcome. Thank you for inviting us into your home and office today. So just like Paige said a moment ago, we read the comments you write in our end of session survey, and that's exactly why we're presenting this material today. We believe that bringing in an expert to talk about reserve fund investment fills a big hole in reserve study education. We here regularly teach about how much reserves you should be setting aside, what to be reserving for, or knowing if you should feel good or bad about the size of your current reserve fund. It's an entirely new subject to talk about taking good care of those precious reserve funds, and that's what we'll be addressing today. This is how we'll divide our time. I'll start out laying a bit of introductory foundation before Dave shares some of his insights about investments. But it starts out with the appreciation that everything deteriorates and everything is expensive to repair or replace. So in this whole process, the associations need to have cash available to pay to care for their facilities. Many associations set these funds aside gradually on an ongoing basis, and that's what we recommend. Now, some associations wait until the last minute and don't hold much in their reserve fund at any particular time. That's risky because you can't rapidly collect cash from the homeowners or get a bank loan. That all takes time. And because of that, you'll end up plunging your property into potentially expensive decay. But again, with recent bank failures, there's also some risk to losing the money that you've collected. So that's why we're presenting this webinar today, because there's risks on both sides. In dealing with these challenges, there's three parties involved: the board and manager, who are responsible for the association's finances; the reserve study professional, who identifies the upcoming needs of the property and recommends how much needs to be set aside to prepare for those projects in a timely manner; and the third party is the investment counselor, who serves like any other expert the association relies on to provide wise counsel. And that person helps the board safely and wisely navigate the way forward. So let's look at these roles a little closer. The board is responsible for managing the needs of the association, setting the budget, which means collecting the income and controlling the expenses so the corporation is sustainable. And in making all those decisions, the board serves under the business judgment rule, and that limits their liability exposure when they're doing their work serving the association if, and here's the key, if the record shows that the board passed the following three-part test. So this is a big deal, that the board served the association with a duty of care, meaning they put the time and energy in to make good decisions; with a duty of loyalty, meaning they put the needs of the association above their own; with a prime example that they should raise assessments if the association needs the money, even if that puts a pinch on their own personal budget. And the third is a duty of inquiry, meaning they asked questions when the answer was not patently obvious. So in other words, as a board member or manager charged with taking care of other people's money and making decisions that affect the value of other people's real estate investment, the only safe path forward is no guessing and no risk taking. Now, for the reserve study professional, we're responsible to guide the association forward using National Reserve Study standards so they have sufficient cash to take care of the property. Now, we recommend a smooth and stable funding plan that's evenly spread over the homeowners and is fundamentally fiscally responsible. It's not responsible, as I mentioned a moment ago, to ignore the very real and high cost of ongoing deterioration and rely on those last-minute special assessments or costly loans. And the role of the investment counselor is to provide expert advice, expert counsel to help the board make wise decisions about what to do with the money, how to manage that money, applying best practices, saving them time and the administration of that money, and then helping them avoid mistakes. And that brings us to the meat of our program today, some time with Dave Lynn, who will provide some insights about what to do with your precious reserve funds and how to keep them safe. So Dave, welcome to the program. The microphone is yours.
Thank you, Robert and Paige. It's a pleasure to be with you here again. Thanks everyone for listening. When it comes to your duty as a board member or community manager pertaining to reserve funds for an association, I believe you have three main priorities. The first is to have 100% safety of the homeowner's money. The second is to, we say, optimize liquidity. And that means having the right amount of money liquid when you need it for expenses. And third, trying to get you the best rate of return on those funds without, of course, sacrificing safety or liquidity. Let's get back to safety here. It's pretty much an industry standard now. 35 years ago when I started, it was a little bit more of a Wild West, but now it's generally accepted that 100% safety means that associations should invest only in FDIC insured CDs. The CDs should be purchased in amounts less than the $250,000 so that not only the principal, but accrued interest is FDIC insured. And you want to make sure you don't have more than that 250 with the same financial institution spread out over different bank branches. Occasionally I'll come across a potential client that has $200,000 with a particular bank in 3 different bank accounts. So they're only insured up to $250,000 per financial institution. Another investment that's considered appropriate for community associations other than the FDIC insured CDs are FDIC insured money markets. There's lots of different money markets out there, and bank money markets are not always or not necessarily FDIC insured. So you want to make sure that your liquid funds, in addition to the CDs, are FDIC insured. And in my opinion, the only other investment other than FDIC insured CDs and money markets that are appropriate for community associations are U.S. Treasury bills, Treasury notes, and Treasury bonds. And those are individual Treasury securities that are purchased in the name and tax ID number of the community association. When, well, say over the last year and a half, 2 years, as inflation reared its ugly heads, one of the number one reasons for telephone calls I would get would be how to get a better rate of return. Inflation's up, our interest rate's going to come up. What's the Fed going to do? But since March 10th of this year, we've had 3 of the 4 largest U.S. bank failures in U.S. history. And now the focus is rightfully back on safety as, again, the number one priority. I would encourage every board member and community manager to make sure not only that your reserve funds are fully FDIC insured, but also the operating funds. The Community Association Institute recommends keeping about 2 to 2.5 times your monthly operating expenses in a bank operating account. So if you have $100,000 in monthly expenses or less, you can keep less than $250,000 in that bank operating account and be fully FDIC insured. If you're a bigger, maybe a master plan community, and you need to have much more money in the operating account, then we can talk offline about some ways to mitigate that risk or how to break up your operating account so that it's insured. You as board members have a fiduciary responsibility to protect and maintain the assets of the association. That means not taking risk, essentially, with other people's money. You're not trying to beat the Dow each year. You're not going to get a standing ovation or a raise at the annual meeting if you get a 12% return. But I know there's a number of attorneys out there that would love a class action suit against the board of directors because you have your D&O insurance or E&O insurance if you lose a couple $1,000s in an investment that went south. So all of the clients that we work with at my firm are 100% FDIC insured or in individual Treasury securities. That way, you're not taking any risk with other people's money and you're doing the right thing for the community. Just to reemphasize, the FDIC insurance limit since 2008, it went from $100,000 per financial institution to $250,000 per financial institution. So if you have a $250,000 CD, you purchase that at a bank, that means the next day, the accrued interest, the interest earned overnight, is now over the FDIC limit. So you want to make sure you're within or below the $250,000 FDIC limit. One of the things that everyone learns in their investment class, whether it's in high school or college, or if you're in the financial services industry, is that their risk return graph, that is with increase in anticipated return, you have to accept an increase in risk. And again, we're trying to work in as nearly a zero risk environment as possible. Therefore, if you stress safety as your number one priority, liquidity as your second, and then getting the best rate of return possible as a third priority, you're going to fulfill your fiduciary responsibility. You're going to get in trouble if you start listening to those homeowners that say, well, my brother-in-law has this mutual fund that's never lost money. We can put a little bit of funds in there, just 10% of the reserves. I strongly recommend against that. Your CPA and your attorney will also recommend against that. I can almost guarantee you. So remember, we're in a zero risk environment with other people's money. Stick with CDs, stick with U.S. Treasury securities, and with FDIC insured money markets. Usually this slide is accurate. Right now, because the Fed has increased interest rates so quickly over the last 18 months, and then they paused by only increasing rates 25 basis points last month, what we've seen is a compression of the yield curve. And that means that a 3-month CD yields about 4.9%, and a 3-year CD yields about 5.2%. So the difference between 3 months and 3 years, and this holds true for treasuries by and large, the difference is about 0.25%. Some people say that's because we've hit a peak in the market and the peak in the interest rate cycle, and rates will start coming down later on this year. I don't necessarily hold on to that theory, but typically, if you invest in a longer term investment, you'll get a better rate of return. But that's not the reason to invest in a 3-year CD versus a 3-month CD. Nor is it right now. I have clients call me up and say the difference between 3 months and 3 years is very little. Let's just put it in 3 months. I advise against that because you're taking reinvestment risk. That is the risk of having these funds mature in what may be a lower interest rate environment. So you'd like to spread out your money by laddering or staggering the maturities of CDs so that you have several CDs maturing each year over the next few years. And that way, regardless of what happens with interest, you're going to get a good, competitive, long-term rate of return. If you have a good 3-year ladder with money maturing every 3 or 6 months and interest rates go up, you'll have plenty of money maturing over the next year or two to reinvest and take advantage of those new higher rates. Conversely, if interest rates start to come down, you'll still have money maturing out there at 24, 30, and 36 months, as an example. It'll be locked in at what will then become an even more attractive rate as rates come down.
Hey, Dave, let's throw a wrench into this and put a twist into this. You've been talking about how long you can set things aside, some 36-month options, but there are times that here in the community association world, you are going to need the money. And that's the role of the reserve study in this story. So let's look at this 30-year map of expenses. And you can see that in this case one, their first significant need for reserves is about 1, 2, 3, 4, 5 years in. So that's past the 36-month, 3-year time limit that you're talking about. So this may not be significant, but what about this case two, where their significant cash drop is 3 years away? You want to be prepared for that, making sure you're not tying up too much money, making sure you have plenty, as you've said, liquid, readily available. Or let's look at this case number 3, a different profile where their largest cash needs are 10 or 20 years away, but they do have some significant cash needs at this time. So when you're working with a client, these are the kind of questions you need to be asking to know how much of your funds can we set aside? How much can we maximize? How much are you likely just plain going to spend this year? Is that fair?
Yeah, that's exactly right. And we use, I would assert that a good financial advisor is going to look at an association reserve study and use it as a roadmap in setting up a laddered CD portfolio. So rather than just blindly purchasing 6, 12, 18, 24 month, 30 and 36 month CDs and even increments, we want to look at the reserve study and then speak to the the board members and the community manager, because we know that some reserve studies, it may have been done 2 or 3 years ago and they need to be updated. And now roofs are failing faster than they thought, or maybe you don't have a big expense coming up next year. So we use the reserve study as a roadmap and then make sure it's accurate by communicating with the board and the community manager. And then we will temper that CD ladder based on anticipated expenses. So rather than just having an even amount maturing over the next 3 years, maybe, as you had indicated, maybe there's a huge project coming up in the spring of next year. So we will more heavily weight 6 and 9 month CDs as an example in that maturity, so that the funds are available to meet that anticipated outflow. I had mentioned the CD laddering, and the general idea here with our firm anyway is to we recommend keeping roughly 10% of an association's funds in a series of FDIC insured money markets. And then the other 90%, we recommend laddering or staggering the maturities of CDs. Again, so you have something maturing a couple of times a year. That way, as interest rates fluctuate, you'll have some money locked in. If rates go down, as I stated earlier, and as rates continue to rise, you'll have money maturing that can then be reinvested at those new and even higher rates.
So laddering is this concept of taking money that has matured, reinvesting, and then reinvesting. Is that fair?
Right. So if you set up a 3-year CD ladder with CDs maturing every 6 months, then 6 months from now, your first CD is maturing and everything other CD is 6 months closer to maturity. You would typically reinvest the maturing CD into a 3-year CD. And that way, over time, your portfolio has the average yield of a 3-year CD, which is almost always higher than the yield of a 2-year CD or a 1-year CD. But you have much more liquidity than were you to just buy a 3-year CD, because you have money maturing every 6 months, as well as roughly 10% in the money market. So yeah, as I stated earlier, we want to, no matter who you're working with, make sure they're familiar with reserve studies. I know reserve studies can be anywhere from 20 to 200 pages, but the pages that a financial professional will want to look at is a chart that shows remaining useful life and replacement costs of all the items. And then we want to make sure that the CD ladder we're proposing will match up appropriately with those anticipated expenses. So the question is, when would you need a financial professional? I would say, generally speaking, the more money you have, the more complicated the issues are, and the more you would benefit from working with someone that specializes in reserve fund management. If you have $200,000 total in reserves, you can keep everything in one financial institution and just through that institution purchase or set up a CD ladder. You don't have a lot of selection or variety in CD rates, but you can keep everything in one account and everything's consolidated. For associations, if I have an association that comes in with $2 million, if they're not working with me, they're going to need 9 different banks in order to keep all of their funds FDIC insured. So that's 9 different signature cards. That's 9 different statements going to the management company. Every time a board member changes, it's a whole lot of paperwork. It's a lot of reconciliation. So I would say that, once you're over about 500,000 or even 250, you'd want to see what an investment professional, someone that specializes in working with community associations, see if they can help you.
And how much does that cost?
Hopefully it will cost you, if you work with the right people, it won't cost you anything. And that's because at my firm, for instance, we use First Clearing Corporation, one of the largest custodial banks in the world. And we have 300 to 400 banks that will participate in the CD inventory at First Clearing. So for a bank to participate, to have their CDs made available on this nationwide inventory, they will pay First Clearing an underwriting fee. And then when I will purchase a CD in the name and tax ID number of a community association, and it goes in that association's account, I then receive a portion of that underwriting fee. You shouldn't be paying an annual fee or a commission, and heavens don't pay. You'll have some people out there that want to charge you a percentage for managing their assets. There's a 0.25% or 0.5%. That's way too expensive. You can work with professionals that have a national brokered CD inventory, and then you end up having the banks pay the fees and not the association.
I love hearing that the banks pay the fee.
Yeah.
Well, thanks, Dave. It's time now to turn the corner a little bit and address a related issue, and that's inflation. Dave, you've been talking about investment safety, liquidity, and return, but the question is, what are boards to do with inflation still high? Launched high last year. Does that affect their decisions? How does that change things?
Well, I would say it doesn't affect their investment decisions, or it shouldn't affect their investment decisions as much as it does their spending decisions. And by that, I mean, if inflation is high, maybe a board wants to look at completing projects sooner rather than later in anticipation of them costing more money in the future. But as far as investing, the real rate of a return of a CD after inflation and after taxes has always been about zero, regardless of where inflation is or taxes. Your primary purpose for investing in CDs or treasury securities is to not lose money. So when inflation is low, interest rates are typically low. And as inflation increases, the Fed will increase the Fed funds rate, try to keep inflation in check. So again, whether you have low inflation or high inflation, I would say you would invest based on anticipated expenses rather than on, where rates are, inflation rates or investment rates at a particular time.
I guess what I'm hearing is that you got to do your investing, make your smart investing decisions, and don't expect to earn enough interest to ever beat inflation. Inflation is generally going to happen. It's going to be out there. And on the reserve study side of things, the inflation works on the entire project, like the entire roof cost. If it's a $100,000 roof, that $100,000 roof gets, with 5% inflation, turns up to $105,000. Whereas if you only have $50,000 set aside in the bank for that roof project, you're only getting interest on that fraction that you actually have in cash. So there's this economic reality of the difference in how the numbers change. The numbers are going to change faster with inflation than they do with interest. So just plan for that difference. Fortunately, we can do that in a reserve study. We know what those numbers are, or we can make good estimates for those numbers. And here's kind of an idea of what that looks like. On the left, you can see a column of different types of associations, a HOA or planned unit development, townhomes, condo apartment style, and then condo high-rise style. And when we look at our clients, the average reserves on deposit, not a lot for the HOA PUDs because they're not maintaining residential structures. It's just a lot less that they're dealing with there. And there's more cash that the townhome, condo, apartment style, condo high-rises are sitting on in their reserve fund. Now, if there is even a 5% split between what you're earning in interest and inflation, and that's a significant split. For a HOA, it's only $50-$60 a year for the average homeowner. So it's not a lot that needs to be compensated in the reserve study. For the other types of associations, it's a couple $300. So spread that over the entire year, and that's very manageable. So the point we want to make is that your reserve study provider is looking at these numbers and is building that difference, that cost, those changes into your multi-year reserve plan so that you are getting prepared to have the right amount of cash at the right time in the future. So don't worry about trying to do something that's impossible. Get enough interest to offset inflation. Your reserve study provider is managing that in the reserve study. And that brings us to the summary portion of today's program. I want to leave you with a visual, and that's a view of what a healthy budget looks like. So this is the cash flow through an association. When we look at what the actual numbers are with our clients, the idea is that a healthy budget has most of its money running through paying the daily, weekly, monthly operating budget expenses, 55 to 80%. A healthy association needs to be setting aside reserves in the range of 15 to 40% just to keep up with that ongoing deterioration. And there's always surprises, whether that be owners that aren't paying or a surprise expense here or there. Figure a rough number 5%. So this is an idea of what a healthy budget looks like as far as cash flow. And just a comment, it's a investments and inflation webinar, but I'm a reserve study provider, so I got to say, if your reserve funding is well below 15% of your budget, most likely you've been fooling yourself and you're actually funding the same amount to reserves, but doing it with periodic special assessments. Those expenses are there. You really can't run away from those expenses. So if you're not setting aside reserves on an ongoing basis, you're probably catching up with special assessments every few years. Now, the keys to success, it's kind of a four-part series here. First, make sure you're taking care of the needs of the association. If you're not prioritizing the needs of the association, you're probably not caring enough about what's going on at the association to really benefit from this webinar. Second, keep those reserve funds safe. That's a first priority Dave's been talking about. It's hard-earned owner money that you've collected, so don't put those funds at risk. Third, Remember that your job as a board member or manager is to make decisions, guide the association forward, not do everything yourself. So getting wise investment counsel and updating your reserve study are all areas where it's likely a smart idea to get that outside expert help. And finally, update your plan regularly. Costs are changing, life expectancies are changing, interest and inflation are changing, your reserve balance is changing. All these things are changing. So update your plan, your reserve plan, and your investment plan regularly. Now, if you want to test some of these adjustments yourself and see what difference it makes, our clients are at a distinct advantage here at Association Reserves because they all enjoy access to our UPlanet online reserve calculator where you can test all your what if ideas free of charge. You can literally go in and change your interest from 1% to 3% or 4% or 5% and see what difference that makes in lowering your reserve, your homeowner reserve funding requirements. And the access is for the duration of your budget season. That comes free with every full update with site visit and update no site visit reserve study. And if we didn't prepare your reserve study, or if it was more than a year ago, you can subscribe and get a budget season of UPlanet for just $399. Well, Dave and I want you to have success at your association. We're here, and experts like us are here to be your trusted guide through all the reserve study and investment decisions that come along in your path to the future. If you want to look through our library of articles or videos on our website, go to www.reservestudy.com. At the top right of the homepage, you'll see a link to where you can order a reserve study proposal for your association and get us on your team. And at the bottom of every page, you can sign up to get notified of future webinars like this. And when I heard that 75% of the people here today are board members, it's great to know that we have a new resource for you. It's a weekly 30-minute podcast just for board members or designed for board members, meant to equip and encourage you in the hard work you do leading your associations forward. So you can subscribe from any major podcast platform and enjoy on an ongoing basis. And we've asked Dave to be a guest on one of our future podcast episodes. So it's that kind of expertise and insights that we'll keep bringing to the table week after week after week. Now, Dave has a lot of great resources at his website, www.lynnwm.com, lynnwealthmanagement.com. And you can learn more about the services that he and his team provide for associations across California and Texas. And that brings us to the end of today's prepared content. So I'll turn the microphone over to Paige for our Q&A time.